Welcome everyone to Wealth Mastery, your ultimate destination for unlocking the secrets of financial success. Today, we are embarking on an exciting journey into the captivating realm of banking. Get ready to unravel the mysteries behind fractional reserve banking, demystified how banks create money. Hold on tight because this is going to be an eye-opening experience. Have you ever wondered how banks manage to lend money to individuals and businesses while still safeguarding your hard-earned cash? It's all about fractional reserve banking, a concept that might sound like magic, but it's far from it. When you deposit money into a bank, they are only required to keep a fraction of it as reserves. The rest? Well, that's where the magic happens. The bank takes the remaining portion of your deposit and loans it out to borrowers eager to make their dreams come true. But wait, how do they do it? Let's break it down step by step. You deposit $1,000 into your bank account. Reserve requirement. The bank is legally required to keep a fraction, say 10%, of your deposit as reserves. In this case, they keep $100 in reserve. The bank takes the remaining $900 and lends it out to someone who needs a loan for their business or other endeavors. The borrower now has $900 to spend, perhaps by hiring employees, purchasing inventory, or investing in new equipment. This money eventually finds its way into other people's bank accounts. The money multiplication process. Imagine this. The borrower receives the loan and uses it to fund their ventures, purchase a new home, or invest in their future. But here's the incredible part. When the recipient of that money deposits it into their own bank account, the cycle continues. The bank, in turn, can lend out a fraction of those new deposits to someone else, creating even more money. This process can repeat multiple times, leading to a multiplication of money in circulation. For example, from the initial $1,000 deposit, the bank can create up to $9,000 in new loans if the reserve requirement is 10%. That's $10,000 in total money supply from just one initial deposit of $1,000. The pros and cons. Of course, like any financial system, there are advantages and disadvantages to fractional reserve banking. On one hand, it stimulates economic growth by increasing the money supply. This facilitates investments, entrepreneurship, and overall economic prosperity. By providing access to credit, fractional reserve banking enables businesses to expand, create jobs, and drive innovation. It also allows individuals to finance major purchases like homes and cars, which otherwise might not be possible. However, this system is not without its risks. During times of financial instability or when people lose confidence in a bank's solvency, it can trigger bank runs. A bank run occurs when a large number of customers withdraw their money simultaneously, leading to potential financial crises. Fractional reserve banking has been an integral part of our financial landscape for centuries. It has played a significant role in fueling economic growth and supporting businesses and individuals in their pursuit of financial success. Nevertheless, as we delve deeper into the world of finance, it's essential to recognize both the advantages and risks of fractional reserve banking. Understanding these intricacies empowers us to make informed decisions about our finances and helps ensure a stable and resilient financial system. Advantages of fractional reserve banking. Now that we've demystified the process of fractional reserve banking, let's take a closer look at some of its advantages. As we discussed earlier, this financial system plays a crucial role in driving economic growth and promoting financial prosperity. Economic growth. By allowing banks to lend a portion of their customers' deposits, fractional reserve banking injects more money into the economy. This increased money supply facilitates investments, stimulates consumer spending, and fosters overall economic growth. Access to credit. Fractional reserve banking enables individuals and businesses to access credit easily. Whether it's funding a startup, buying a home, or financing a new project, borrowers can benefit from the availability of loans and credit facilities. Financial intermediation. Banks act as financial intermediaries, connecting savers and borrowers. They bridge the gap between those who have excess funds, savers, and those who need funds, borrowers, fostering a more efficient allocation of capital. Disadvantages of fractional reserve banking. However, with great power comes great responsibility, and fractional reserve banking is not without its challenges and risks. Let's explore some of the disadvantages associated with this system. Bank runs. Fractional reserve banking leaves banks vulnerable to bank runs. In times of financial panic or uncertainty, if a significant number of customers rush to withdraw their deposits, it can deplete the bank's reserves, potentially leading to insolvency. Economic instability. In certain situations, fractional reserve banking can exacerbate economic instability. For instance, during a credit boom, banks may become overly lenient in lending practices, leading to an unsustainable buildup of debt and asset bubbles. Central bank intervention. To maintain financial stability, central banks often step in as lenders of last resort during a crisis. While this intervention can mitigate short-term issues, it may also incentivize banks to take excessive risks, knowing that the central bank will bail them out if needed. Regulatory safeguards. To address these risks, regulatory authorities implement safeguards to ensure the stability and soundness of the banking system. One such measure is the imposition of reserve requirements on banks, mandating a certain percentage of deposits to be held in reserve. Additionally, central banks use monetary policy tools, such as adjusting interest rates and open market operations, to manage the money supply and influence economic activity. The future of fractional reserve banking. As we look to the future, the landscape of banking continues to evolve. With the advent of digital technology and fintech innovations, new players are entering the financial arena, challenging traditional banking models. Cryptocurrencies and blockchain technology have also disrupted the financial world, prompting discussions about the potential for digital currencies to reshape the concept of money and banking. In the face of these changes, traditional banks are adapting, embracing digital transformation, and exploring ways to enhance customer experiences while managing risks. In conclusion, fractional reserve banking remains a fundamental pillar of our financial system, powering economic growth and enabling financial transactions worldwide. While it comes with inherent risks, proper regulation and prudential measures can ensure its stability and usefulness in fostering a vibrant economy. As you continue on your journey of financial mastery, understanding the intricacies of banking will empower you to make informed decisions, navigate economic shifts, and build a solid foundation for your financial future. Thank you for joining us on this enlightening exploration of Fractional Reserve Banking Demystified, How Banks Create Money. If you found this video insightful, don't forget to hit that like button and subscribe to Wealth Mastery for more enriching content on mastering your wealth and financial well-being. Remember, financial education is the key to unlocking a prosperous future. Keep learning, keep growing, and keep mastering your wealth. Until next time, take care. And may your financial journey be filled with abundance and success.